Hello, good afternoon. My name is Gautam Naik. I write about climate change and ESG for Bloomberg. And we're here to talk about an insurance crisis. It's called the insurance protection gap. And it's the difference between economic losses caused by natural catastrophes and the insurance that's available to cover it. This is a problem that's been around for a long time, but in a world that's buffeted by climate change, it's taken on a new urgency. And I just want to read a few statistics just to give you the lay of the land of how significant the scale of this problem is. So we all know that, natural catastrophe or NatCat losses are rising every year. In 2024, economic losses from disasters was about $318 billion, but almost 60% of that globally was uninsured. And just this morning, a very alarming headline crossed my computer from Bloomberg Intelligence, which said, climate-related GDP losses in the US have reached $6.6 trillion over the past 12 years, a figure that's no longer just an environmental concern, but a significant financial issue. This cost is second only to the great financial crisis of 2007 and exceeds the impact of both the Great Depression and the savings and loan crisis. So as you can see, this is a global challenge, and this insurance protection gap, as it relates to natural catastrophes, is pretty significant in vast parts of the world. So in the US, it's about 40 to 50%. In Europe, it's 75%. And it's much worse in places like India, where it's over 90%, and Mexico and South Africa. So it would appear that governments, insurance companies, regulators, and other players are perhaps failing us, or maybe the problem is just too intractable. And I just wonder if we could start by introducing ourselves on the panel here. Just if you could describe, your role at the institution you work for. Nicolas, do you want to start?
Yes, happy to. Thank you very much for the invitation. I'm working for Insurance Europe, which is the European Insurance and Reinsurance Federation. So we represent the insurance sector through the National Associations of Insurers, like DABI in the UK. And there I'm heading the general and personal insurance team. So I'm looking at regulatory developments primarily at EU level that have an impact on the different business lines of insurance companies. And of course, the question of natural catastrophes and the question of the insurance protection gap has been very high on the agenda for the last couple of years.
Okay, I'm Ekhosuehi Iyahen. I'm the Secretary General of the Insurance Development Forum, which is an industry-led initiative, but with the public sector, specifically the World Bank Group, as well as the UN, and really with a focus on how do we help developing countries to build resilience, really leveraging the capabilities that exist within the industry. And again, our focus really is on emerging developing countries, but it's also a space that I think bridges some of the concerns that we see emerging in developed countries, and really, again, trying to bring both public and private to tackle what I think is quite a deep structural issue, as you've alluded to.
My name is Irene Heemskerk. I work for the European Central Bank, and there I had the Climate Change Center. It's a unit that's been there for 4 years, and our job is really that we take into account at all arms at the European Central Bank on the monetary policy, financial stability, banking supervision. What is the impact of climate change, being it through the transition or being like addressing the physical risks? And making sure that our models are up to date, that we take into account and we really assess it and take action where needed.
Well, thank you, Irene. So just with your permission, I'd like to sort of structure this in two parts. One is to first go around talking about the scale of the problem in each of your expert areas, and then to talk about what possible solutions are out there, what's being implemented, which work and which perhaps don't work. So just to talk about this from a high-level perspective, the ECB has been talking about climate change being a systemic risk for a long time. And I was wondering, just to start us off, if there's any evidence that it is posing to be a systemic risk to a financial structure of Europe. We know that, of course, industries and economies are affected. You have a drought, agriculture is affected, you have floods, residential market is affected. But in terms of a systemic crisis, is there such a thing yet from climate change, or is that still something a bit fuzzy and out in the future?
It's I think, the biggest question out there. If I'm being realistic, I don't see it here clear and present danger today. But it's something we should really worry about, because when you see all the transmission channels from climate change, there's so many. So if you are a company somewhere in the east of Germany and you're dependent on your supply chain, and all these kind of transmission trends through the whole economy, I think it's really big. And from the ECB, we've been looking at this from, if we're talking about the physical impact today, it can impact the economy, really the macro economy, so really impacting GDP, because if you think about the catastrophes in Germany, just think about those companies, you see that the assets there are being hit, but it's also more the chronic impact, so extreme droughts over a few years' time, you see that agriculture is being affected, or if you think about the canal houses in Amsterdam, they're all built on these wooden beams. Groundwater is lowering because there's less water, so all these beams get rotten. Approximately 64,000 euros per household needs to be invested in that. So these are just like agriculture, we see it on productivity lines, we see it basically infiltrating through all the sizes of the economy. Then there is, of course, the financial stability and the financial risk it's causing. If you're a bank and you're invested heavily in some areas that are exposed to risk, it could, your collateral could be losing value. And with that, it could, of course, there are higher risk on your balance sheet, but it also limits what you can invest in the recovery again. And then finally, I think the previous panel, I heard a lot of fiscal space as well. If you think about government debt, if you think about the floods in Valencia, the Spanish government in the end put in 14 billion. That's about 1% of GDP. They can do it once, maybe twice, but not that often. And if you see now the increase of extreme weather events, like acute, but also the chronic ones, it's really something we have to be worrying about and take action.
Yeah. Now, the reason I asked about systemic risk as to whether there's an imminent problem is because as your role as banking supervisor in Europe, one of your jobs is to make sure that banks sort of align with whatever climate, scenario, 1.5 degree, and they're clearly not doing that. Why is that? What's the challenge?
The alignment of banks on the 1.5?
Yeah, they seem to be sort of regressing a bit in their climate commitments.
So this is beyond the physical risk space, but this is on transition risk. What we see there, and thinking about our mandate, we want banks to manage their risk. And we want to make sure that they're investing, they know their exposure to carbon-intensive sectors, and they have a plan to get out of it and manage those risks when needed. This is the opinion we have. We're not policymakers that can set trajectories of, okay, banks can no longer invest in fossil fuels.
Right. But do you think they're doing enough, I guess, is the question.
Well, we have quite a supervisory trajectory for banks. So in 2020, we issued supervisory expectations explaining what we expect banks to do to manage both transition risk and physical risk. We upgraded that, and we even set deadlines by the end of last year. By the end of 2024, we want all banks to meet all our supervisory expectations. And in case they're not, we won't shy away from supervisory enforcement actions. And this is what we're doing in some cases. So are they doing it enough? I think a lot of progress has been made by the banks over the past years, but not all of them are at the place where we want them to be. And that's what we're working on now.
Okay, thank you. So Nicolas, the insurance companies are in an interesting position on both sides of the balance sheet. Obviously, you make considerable profits if you're an insurance company by insuring oil rigs and LNG terminals and the like, and fossil fuel investments. At the same time, on the other side of the balance sheet, you have to pay out when there are natural disaster claims, and that number is only going up. Let's talk about the first bit. There is a general feeling that insurance companies, although they have exclusions on, not insuring certain type of fossil fuel assets, they continue to, insure a whole lot of others. And under a sort of drill baby drill regime and sort of general backsliding on this, it would seem that insurers would be more than willing to keep insuring these assets if there are more of them out there. How is the insurance industry going to tackle this perception, at least?
Well, I mean, the good and important question, of course. I think maybe a caveat in a way as a representative of the sector in general. I'm not in a position to comment on something which is at the end of the day the sole decision of each and every company in the sense of how they invest and what they underwrite, what risks they underwrite. What I would say is that there has been a lot of initiatives being taken at the individual companies level and through alliances, and a lot happened after COP21 in order to decarbonize the portfolio, and that covers indeed the investment side and the liability side of the balance sheet, so not underwriting certain activities, and that has been done usually with the 1.5 trajectory in mind, and companies have decided not to underwrite certain new coal projects, tar sand projects. I mean, that again is very much an individual company decision. In terms of also reducing emissions, there is obviously the firepower that insurance companies have through their investment, and there we have seen also an evolution in terms of investing in renewable energy, in solar panels and wind farms, and that has been quite important in the last couple of years, also with the momentum of the Paris Agreement to an extent probably. I think the question really is how we transition, how we decarbonize our economies and our societies, how we can accompany that process through the activities of insurance, how can insurance companies accompany that process through their investment and underwriting. So that's really the big question, but I don't think that it is realistic to expect things to happen single-handedly through the insurance sector. I believe there is also a societal responsibility if companies were all together to stop insuring certain activities. That would have important societal consequences. So I think we really need to do that together, different business sectors, and with the support of governments in order to accelerate this transition toward net zero.
And in terms of the rising insurance losses from natural catastrophes, in some markets, notably in the US, but also I guess parts of Europe as well, premiums are certainly going up a lot in places like Florida and California. Insurers are fleeing the state because of wildfires or hurricanes or whatever, because they don't want to insure this kind of high-level risk. Is there anything the industry can do to close the protection gap in terms of its own response? Because if you keep leaving markets and if you keep raising premiums, that insurance gap will only increase, won't it?
Yeah. I mean, the situation is certainly different in Europe. You have shown the graph with the protection gap. First thing to say is that the situation is very different between the different countries, between different member states of the EU. So the protection gap varies quite a bit. You have also in certain countries where you have schemes in place and others where it's left to the forces of the market, let's say. But even within those categories, there is a very big difference in terms of penetration of insurers. And indeed, there is a protection gap. There is a chance that the protection gap may increase in the future. I think it's important to keep in mind that there are various factors that lead to a protection gap. One is climate change, which is undoubtedly resulting in an increase in the frequency and severity of a number of nat cat events. But there is also the big question of how we build and where we build. And one of the reasons why there may be properties or certain risks that are difficult to insure at an affordable price is that we see that in every country we keep building in areas which are considered at risk of flood, for instance. So there is really, I think it's important to point to the fact that climate change is one factor, no doubt about that, but there are also a number of other important factors that need to be looked at. Right. At the end of the day, insurance has a huge role to play, but we are also, as insurers, at the end of a chain, and a lot has to happen during the chain in order for certain risks to be insurable. And the question of where we build is a very important one in that context.
Thank you. Well, when it comes to natural catastrophes, emerging markets are in a particularly powerless state because we know that the developing world is responsible for a very small percentage of greenhouse gas emissions, and yet it's facing the brunt of the natural disaster risks. What's the challenge in terms of increasing insurance and making sure that there's a safety net? Because a lot of developing countries obviously are deep in debt. They spend a lot of their free cash flow paying off that debt. They can't really spend money on adaptation or mitigation. What are some of the best, how significant is the problem? I mean, I know we're talking about a very varied group of countries, but just broadly speaking.
I think it's a great question. Maybe to set the context, most emerging developing countries, we're talking about 1 to 2% insurance penetration rates, right? Most developed markets, we're talking much higher figures, maybe 40%, et cetera. So that gives you a sense, as you've said, of what happens when you do have these catastrophes. You also have, yes, some diversity. You have small islands, they have a single event. It's 200% of damage, loss to GDP, right? So that's a deep hole to climb out of. So for us, when we think about this issue of, climate or natural disasters that countries are faced with, we think that there are a lot of capabilities that exist within the industry that can help to address some of that. First is, how do we better understand these risks and the evolution of these risks, and also express that to policymakers in a way that they can take action? So if we talk about drought, yes, is impact on crops, but it's when crops are devastated, you have to find a way to respond to those people, or the amount of resources that are required to get people back to a basic livelihoods is significantly more. That is a drag on the economy. Money that should be spent on education, health, etc., is being spent on responding to drought events here and there again, and also in a context where you do not have deep insurance markets. So I think that there is a fundamental in terms of how industry understanding of risk can be used to better communicate these risks to policymakers. The second is, frankly, we need innovation in products, right? The challenges that emerging markets face, yes, there are products that exist in the traditional market sense that are relevant, that we need to continue to expand. But we've also seen innovations with use of parametric insurance solutions. We've seen regions begin to pool their risk, for example, in Africa, the Caribbean, the Pacific. And that's really with the objective of how can they create scale in order to be able to access the market in a way that is much more affordable. And then there are other things that I think that we can do, which is some insurers are, I think, waking up to the fact that they need to provide better risk advisory services to their clients. So for example, Zurich Insurance, it's really about maybe some of the capabilities that they leverage, if it's their risk engineering capabilities where they advise their corporates in terms of how to manage risks through the supply chain. The question that we are trying to tackle in the IDF is, how do we leverage that in the context of the public sector? That then takes me to the final point, which is the need for engagement with policymakers, the need for public-private partnerships. If we're talking about data, if we're talking about innovative risk transfer solutions, if we're talking about addressing the protection gap, we're going to have to require the industry, policymakers, and importantly, regulators to be around the table. So I would say that for us, it's a complex problem. The industry is waking up to it, but it's also how do you align incentives between public and private and ultimately get to implementation.
That's a nice segue into the second half of what I want to discuss, which is possible solutions, what might work, what doesn't work. And if I could start with you, please. So you mentioned parametric insurance. There are, of course, catastrophe bonds, which the World Bank sponsors for developing countries. And there are these very interesting risk pools. Do you think that if these particular specialized and fairly innovative tools were expanded significantly, if it were possible, that would really absorb a lot of the losses of insurance that the developing world is seeing?
Yes.
Okay.
And I say that because the tools exist. Yes, there is scope for refinement of these tools. If we're talking about parametric insurance, the leveraging of data to help us to understand these risks better, but also to reach people. And I can give you an example. Right now, when you look at data from 2023, the global humanitarian financing response was $64 billion US, right? Of that money, only 1.3% was prearranged. So that means that that's money that's sort of ad hoc, sort of found to respond to disasters. But we could actually leverage that in a much more significant way if we say, what about an ambition to move 1.3 to a much larger figure? Right. Working with the industry, helping governments to think about how are you developing disaster risk financing solutions, putting money aside. And importantly, some of the trade-offs, frankly, and you made a very important point earlier, which is a lot of emerging developing country governments are dealing with incredible debt. There's a lot more pressure on every dollar spent. And so there is also an opening within that community to say, how do we better leverage every dollar that we spend, right? And so I think that this is a space where the industry can offer a lot of solutions. And the solutions are not only simply in, okay, responding to disasters, responding to shocks. It's also the fact that in the absence of insurance, it also limits the ability of what can happen in terms of growth. You can't grow if you're not managing your risk. You can't grow if you don't have access to insurance that will unlock access to capital. So for me, I tend to take maybe not a naively optimistic view, but an optimistic view towards we can do something about this.
Okay. What about the insurance industry, Nicolas? What are there, any silver bullets or any innovative answers to this protection gap, especially in Europe? Let's talk about...
No, I think there is no silver bullet, and it's a little bit the opposite. A lot has to happen in a lot of areas. So if you look at what is, in the end, the protection gap, the risk is related to three main parameters. It's the well-known, it's hazard, exposure, and vulnerability. Hazard is climate change. We need to keep the effort on reducing emissions. That is a no-brainer. The exposure, as far as properties are concerned, is really about where to build, and there is really something to be done about new buildings. I mentioned it before, and the vulnerability is about how we reduce the exposure, how we reduce the impact of events that are happening. And there is really where a lot has to happen. You need to look at it in a way, region by region, peril by peril, and need to look at what can be done. There is a lot to be done around awareness raising, a lot about having the right risk culture, the right attitude, and these sort of things. So it's difficult to answer in terms of silver bullet, but there is really a lot to do. Adaptation has to happen at the local level, and that is the reality that we need to accept. And then there is, of course, one of the questions that we are discussing with the ECB and EIOPA is whether mechanism like reinsurance mechanism, pools, etc., yes, also have a role to play. At the end of the day, just mentioning that this can be the case, but the fundamental question of the protection gap is really around reducing vulnerability and increasing insurability.
Yeah, thank you. Actually, perfect segue into the ECB. So in December, you announced this interesting two-pronged proposal to create a voluntary pool, as Nicolas just described, and also a mandatory sort of disaster pool where countries would contribute. So if there's a big event somewhere, that money could be used to rebuild. Could you tell us specifically how long it might be, whether this is implemented or not, and how long it would possibly take, and whether this is realistic? Because I don't really understand the full EU process of how this something that starts with an interesting proposal like this becomes fact.
So first of all, I just want to emphasize like the impact I just shared, like on the economic side and on the government space and also the risk for banks. We really find that insurance can be an important buffer to all of that. And that's why we've done this work with EIOPA. We are now looking indeed, we did this proposal, how can we fill the insurance protection gap? And it's this private-public, so it can't be funded only by public money, so private-public, so more insurance, reinsurance, and some kind of public backing for the risk. And on the more national side, having a pooling with the governments of all the EU states putting money into that. How long that will take, this is of course up to policymakers and up to governments to make an agreement on this. Could take a while, but I do see that the European Commission has adaptation and resilience building very high on the agenda. So they're seriously looking into this, and I'm glad that we have showed and gave a suggestion what can be done. But I just want to emphasize, and I think this talks to what has been said before, this doesn't come for free, right? It also requires that countries take resilience building seriously, and it depends on like the actions you take to limit the risk, also the contribution you have to make to this fund. So to not let it come for free. So I think that's a really important point.
Do you think 2, 3 years, 5 years? Yeah, to put a number on it? No?
No, I wish I could, but I think politics are hard to... But maybe my last point, like everybody in the room, like, do you know which physical risk are you exposed to? Are you taking in your company, in your home, everywhere you go? Do you take it into account? Are you taking like building resilience measures? Do you know how insured you are? I think this is a topic that it's going to be much more crucial that we tackle that soon.